morning, everyone, and welcome to the 101. And that's going to be interesting, given that this is the 101 episode of the Veritas Fact-Finding Series.
Economics 101.
That's true. And today we're joined by David LePoidevin. Good morning, David.
Good morning.
Thanks for making the trip here from Vancouver. Surfacing facts and revealing truths is a never-ending quest for us at Veritas. In each episode, we go on the ground with industry professionals in an unscripted, candid, live video format to look for the truth so that we can help our investors make better investment decisions. In this series, and with everything we do, we believe the facts empower investors and that better information leads to better investment decisions. By way of background, my name is Anthony Scilipoti. I'm the president and CEO of Veritas, which is an independent equity research firm based in Toronto, Canada. And I'm proud to say, celebrating this year, 22 years, 100% employee owned and operated. Quick disclaimer, this broadcast is not to be taken as investment advice, and participants or employees of the Veritas group of companies may own securities discussed in this broadcast. While we love all our guests, this session may contain forward-looking statements, investment opinions, and comments that we may or may not agree with at all. Now, quick comments about David. David has 35 years experience in industry. He started out as a bond trader here in Toronto, and in 1988, began his career at Burns Fry.
It was very short of Burns Fry, yes.
And then hit it off as an investment advisor, and then spent 20 years at a major Canadian bank, that was National Bank. And then recently, in the last, now 2006? In 2006, 2016, you joined Canaccord Genuity. And he's grown his book today to over $2 billion. He has, in 2020, a number of awards, but most notably recently, 2021, he was named #2 top-ranked wealth advisor in Canada by Shook Research as part of the Globe and Mail report that's written. And this year he was named #1 among all Canadian advisors. So congratulations for that, David, and congratulations for quite the career. David, tell us about yourself. I mean, when I'm thinking back, and I've known you over 10 years,
yeah.
And I know that you have a very colorful view of the world. And I could just imagine you in 1986, 85, thinking, I'm going to be an investment advisor. So tell us how you came to where you are today.
Well, it all started, as a parent of twins who are just turning 20. I think the most terrifying words would be, I'm going to take a gap year, which is what I did. Kids, don't do it. But anyway, I did a gap year and I was teaching skiing in Banff, and I taught the head bond trader back then for Midland Doherty. And again, we're going way back in terms of the independent firms. And my first job was a bond runner. So back in the day, you had to deliver the bonds you were trading. So I was bonded for $40 million. I couldn't take any more than 40 million. Here, pick up this 30 million, deliver it, pick them up from Gundy's, deliver them over there. They literally were delivered. And they were in street form, and you literally counted them, and we took pictures of them in microfiche in case they were stolen.
Wow.
So anyway, I was hooked. I just, that amount of money. Then I worked in the summers in the bond trading area, and let's remember back then the bond guys were the king of the castle. There wasn't a lot of interest in stocks when bonds were yielding 12.
That's right.
We'll talk about that later.
Yeah, for sure. Okay, so over your career, what's been some of the keys to success?
Well, like you,
yeah,
we both have a passion.
Yes,
for the markets, and every morning it's a different game, and every morning there's a different interest rate cycle, there's a different political cycle,
right.
And I have a passion for that, and to me it's a puzzle, and I love working out that puzzle. Pretty good at it, not always right, but we do our best. And I think at the end of the day, there's a lot of keys. We'll get into them, and you're going to ask me about independent versus, but at Canaccord, I'm able to do what I feel is the best for the clients. Mm-hmm. And we'll get into that. But anyway, it's been a great career, and I joke with my staff because they say, Dave, are you going to retire? And I said, yeah, I have a plan for that, and it's called the 2-for-1. My retirement party and my funeral. I may as well do them both on the same day because I can save some money.
You're going to save some money on that.
Save some money.
Right on. Okay, so tell us, have you, throughout your journey, you've worked at a big Canadian big bank?
Yes, I've worked twice because I really got my feet wet at Richards and Greenshield. So the bond desk 87 crash happens. I'm graduated, and they go, oh, you know what? Here you were ready to go on the bond desk, and there's like a hiring freeze.
Right.
So literally, like, I'm cold calling everyone on the street, and I managed to get a job at Burns Fry, which I then I left fairly early on and got my feet wet at Richards and Greenshields. We got bought out by a major Canadian bank.
For sure.
So I had one stint at a bank. I went to another bank because this bank was supposed to be very independent. This bank was not like the other banks. But then we found out sort of after a number of years that there's a similarity to those banks, which is I feel, and anyone can correct me if they feel differently, but the banks kind of own the client assets. You work for the bank. I feel that the clients are the assets of the advisor, and you know, we do our wealth business. Canaccord's been a great partner, but we are not governed. They do not call me and say, well, this is our asset allocation you need to be in. So for me, it works very well.
Right on. And so what kind of advice can you give us and give advisors trying to make that decision, transitioning back either between an independent or a big bank platform, et cetera?
I think it's pretty safe to go to a big bank.
Yeah.
I'm a little skeptical of where the industry is going with the bank. You look at what happened at HSBC, yes, and they realized that really all of the clients were just walking in the front door in Vancouver, and maybe new Asians, or I don't want to be racist, but it was a bias at HSBC,
yes,
Hong Kong bank. They realized, why are we giving a broker 50%? Mm-hmm. Why don't we just have our internal managers run this money and we can keep 80%? Mm-hmm. So I think that my advice to young people would be, make sure that it's your business and make sure that you are acquiring the clients. That would be my number one advice. I think it's getting harder to do at a major Canadian bank, and we're seeing some issues. You know, we're attracting people at Canaccord from other big banks because, for example, they want their son to be in the business.
Okay.
Well, we had one fellow that joined with an $800 million book just recently, and he was told, no, we'll tell you where that book is going. Mm-hmm. And he wanted to transition that to his family. So again, a major difference.
Can be.
Yeah.
I mean, I know from having worked with the guys from RBCDS for some time, they're very, I mean, it's really entrepreneurial. I know that, I'm sure that you worked there before, but it's really entrepreneurial, where they really take allow a lot of independence for their
Listen,
IAs.
RBC is the one firm, yeah, that they don't lose guys.
That's correct.
I'll tell you, when I use the word banks,
yes,
I'm being generic because I don't want any lawsuits.
Yeah, I understand.
But hats off to RBC.
Yeah, very good. So tell us, in your 30 years of career, what are the key changes you've seen?
Well, having a stint on the bond desk,
yes,
my first recommendation,
yes,
was you ought to buy 20-year bonds at 11%. No, you chuckle. Do you know how hard it was to get anybody to bite?
Nobody wanted to buy them.
But you know why? It was an inversion. You could get 12% for 1 year. People, David, am I an idiot? I'm not going to get a lower yield. You know, we had this discussion at the Veritas housing conference. That's right? Correct. I went with the floating rate mortgage. It was lower.
Why would I want to lock in at 1.9 when I could do 1.4 on a variable? Talk to them.
So there was the same thing. That was a generational opportunity. But it also, anyway, a few people listened. Those were my first clients. but I've always had that mentality as an investor.
Yes.
You know, I'm looking for stocks. You know, we talked about Manulife,
Yes.
you know, 6% dividend. I'm looking for stocks that feel like a bond-like characteristics.
Yes.
You know, I don't like bonds. So you talk about industry changes. I mean, to go from 12 to 0, you know, in a cycle. I'm a big fan of studying market cycles. And, you know, we went a bear market in bonds from 1946 to 81, and then we had a 40-year bull market in bonds from 81 to 01 to 21. Yeah. And we'll see what's, you know, it's been a terrible 2 years in the bond market, which is, you know, one of the things, lucky, touch wood here, that I was able to achieve the #1 ranking. We went to 0 bonds.
And that earlier,
zero.
That was
Not
year.
That was 2 years ago. I looked at a 10-year at 1%, and yet I'd see my competitors buying bond funds.
Yes.
With a 1% fee, and you're going, I can't figure the math out.
So really, and that's what I've known about you. You're actually taking what's best for the client. Like at the end of the day, you're putting them in something that's 1%, that's costing them 1%. Clearly, that's not in the client's best interest.
Yeah, it was kind of, I call them zombie portfolios. It was just worked in the past, and yeah, but we also had a 40-year bull market in bonds. So
yes,
the bond, you were getting bond appreciation. So these, you know, bond funds were still showing track records of 7%, but the math wasn't going to make 7% going forward. It was impossible.
Right. Because how much lower could the yield go?
Well, it was an argument for negative. I wasn't buying it, but that was the only scenario, and they couldn't stay. You know, listen, in Canada, rates have stayed above 10 a lot longer than they've been below 1.
Yes. So as you look forward, what are you seeing happening?
I think the bond market probably has it about right now. You and I have talked about, and we were talking about at the housing conference, which was excellent, by the way.
Thank you.
The housing conference, and you go, look, rates should be, you know, 1 to 2% above inflation.
Yes.
And we say, well, why aren't they? Because they can't.
Yes.
They can't. There is too much household debt. There's too much debt at all levels. But we also can't be 0. 0 has all kinds of risk, which has fueled the housing bubble, fueled bubbles everywhere. I mean, we made up asset classes in the last few years. You know, and FTX is seeing the fallout of that. But yeah, I mean, these are big changes. I'm not a fan of bonds, but there are some bond equivalents that look really appealing. I think you're going to ask me what my favorite trades are.
Yeah, but we're going to get to that. But when we look at you know, the industry from the standpoint of the advisor, the institutional money management, what do you see happening? Because there's obviously been lots of change, and what do you see happening as we go forward?
Back in the day, there was an old guy when I was a young kid on the desk, and 87 had just happened, and people were white in the face, and Don Boxer came by and he said, guys, the money changers will always do well. I think there's always a need for advice. And, you know, I look at the the Quest trades of the world. People have enough trouble staying in their, you know, S&P 500 ETF, and they go, oh, you know, but the macro news and the pandemic, and they get in, they get out. I think that, you know, even if you have sort of a robo, can you really stick with the program? And again, too much hindsight's investing with those things. I think the future is very bright for independent research, independent thinking advisors. Because if you are just following the bank's model, we talked about RBC being independent and entrepreneurial.
Yes.
But if you're at one of the other ones and you're just following, what value add do you have? And then it's like, why do they even need you as an advisor?
Right. Right. No, it's a challenge. And, you know, we're getting a comment about the fact that for sure, you know, someone sent in a comment. If anybody has any questions or comments, please scroll down to your Q&A, and for sure we'll try to address it here. I got a nice comment from Mark. Reference to bank should clarify that brokerage is not the same. Understood. Regardless of whichever bank or brokerage, do not tell portfolio managers or investment advisors that the client assets are actually the clients, not even, so they're not the banks, they're actually the clients. And that's exactly the point, for sure. And so we didn't want to make that discrepancy.
I mean, the single biggest reason why I had to leave a bank was that we got these, it all went back to the KYC, which is the new account form, know your client, KYC.
Yes.
And at the bank that I was working for, it would ask you how much risk you would want. Well, 80–90% say somewhere in the middle.
Yes.
And therefore, then they would also sign off on an asset allocation. So if you signed off on an asset allocation, we used to get a list of every client that was outside of a 60/40. And then the head office would say, you must get back to that 60/40. Well, that's a problem. It can be a problem if you have a bubble in bonds. The safe, listen, you can, as you know, you could take a safe asset and overpay for it and make that safe asset a risky asset.
That's for sure.
If you overpay for it.
That's for sure. So what are your favorite investment ideas here?
I think we've had 3 fixed income opportunities in my career of 35 years. And I'd say this is the fourth. Okay. Yeah. The number 1 was the long bond, and I missed the 17 3/4 long bond, but even 12 proved to be very good. I mean, we sold those bonds for a huge premium. In the 90s, we bought the real return bonds, 4/4 of 26 back then in the 90s.
Yep.
And we bought them at below par and we sold them at 150. So real yields, if anybody knows anything about history, fixed income real yields are about 1.4. So 4 1/4 was just incredible opportunity. So they went way up. You remember 09 corporate bonds? Tell us, traded at 50 cents.
Yes.
That was number 3. And I think right now we're number 4. Okay. And I'm going to give you some math here. And I'll give you a couple of examples. But TransCanada Preferred A yield 6%. Let's remember what happened. When I was a young guy, the only preferreds that would be issued were retractable preferreds, which means I could give that back to the company. And then no one really worried about the retraction. So they issued perpetual forever bonds.
Right.
And then people said, well, rates are going to go up eventually. So they issued these 5-year fixed floating preferreds. Disaster struck when pandemic or even 09 crisis hit, is because a lot of these preferreds would reset the anniversary would come up and they would say, well, we're going to pay 2% plus the 5-year.
Right.
Well, the 5-year went to 0.39. So you got this dividends were cut in half.
Right. But
I'm going to give you a TransCanada A, which at 14.30 today, in December of 20, so in 2 years, 2024, it's going to pay 1.94 plus the 5-year Canada, which is at 3.3 today. Do the math. 3.3 plus, is 5.2.
Yeah.
But on par.
Yes.
On par.
Which is 25.
We're paying 57 cents on the dollar. This is going to yield somewhere around 9 or 10.
Right.
And
all in.
If we're wrong and we're into a real bear market in bonds and yields are 4.5 or 5.
Yes.
It's going to be up in the 12, 13.
What happens if the rates turn down?
Well, if you do the math, the last time the rates were reset were like 1.5. So if they turn down below 1.5, it's probably going to trade lower. But if you think we're going to be sort of a floor of 2, you will make the dividend will go up. So it's already yielding 6 for the next 2 years because it's so low, not on face value. But look, Bell Canada has a bunch of floating rate preferreds, Bs. I'll just give you one of them, Bs. They pay the prime lending rate. It's trading at 17.90 today.
Yes.
So that becomes 140% of the prime lending rate. Like, I feel like calling RBC and go, you know what? Stop making loans at prime. Buy these Bell. Listen, I said 35. I watched these Bell preferreds. They were originally Bell Alliant preferreds. I watched them for 20 years. They traded at par. Prime. I can't get prime on a savings account. Prime, Last time I checked, the banks charge more to
Yes.
lend than they pay in GICs, else they'd be out of business.
Exactly.
So when you can get the lending rate,
Yes.
but now you're paying, a discount for that. So you do the Enbridge Ds, they're going to reset next March. And the reset is 2.37 plus the 5-year, like March. They announced it in February. So we're 90 days away. There's going to be a massive dividend increase. Just do the math. The BCEDs are trading just over $18.
Interesting.
They should trade to
The problem with the pref market generally is the liquidity issue.
Oh yeah.
How do you get around that?
Well, look, there is volatile or more than
Yes.
say Manulife common stock. So when the market's down 1,000 Dow points,
Yes.
you might look at your pref. Sometimes they don't trade down at all, but sometimes they trade just like a common stock. You say, look, you buy these Bell Canada preferreds in the next 10 years, you're going to get you're paying $17 or $18. You're going to get $15 of dividends.
Right.
If you can't stomach volatility on a daily, weekly, monthly basis,
Yes.
they're not for you. If you're an investor and you say, look, 2 years out, 3 years out,
Yes.
this is not making sense.
I having worked with advisors now for over 20 years, how do you get your clients on side to that? Because that's always the challenge, right? I know over the last 2 years, especially, the calls that you were getting in 2020, sell everything. The sky is falling, people are dying. What do we do? And if those were the time, like had everybody just bought and done nothing else.
Anthony, we're getting them now. I was watching BNN or I was watching something. We're going into recession.
Therefore, sell everything.
So what we do is when I get 5 calls in a day with the same question, and it's, some headline, we're doing a conference call. I do just like this and put it on video. They can call in live or they can watch the replay. We put their replays on YouTube. So if you just Google LePoidevin Group, any of my competing advisors, you can watch one of ours and you can open an account or you could do the same thing.
Or start making your own. I think the key is communication.
So we go, Mr. Client, here's the facts.
Yes.
Here are the facts. Like in the pandemic, we went back to 1900 and studied all the pandemics, including the Spanish influenza.
Mm-hmm.
I was shocked. The Dow closed up that year. Mm-hmm. 50 million people died in the Spanish influenza.
Mm-hmm.
I mean, don't fight the Fed. What tends to happen in pandemics?
And that's the difference, right?
I said
for sure.
To all my clients, the problem's going to start when the pandemic's over.
Yes.
No, it's not over, but economically it's over.
And the problem is now we're seeing the repercussions of all that stimulus.
Yeah, and how do you take it away? You and I have had this discussion. What happens?
Yeah.
Okay, so the money supply is growing at 0. You're going to quantitative tighten. You're going to flood the market with new bonds, which could put the price down even more.
Yeah.
I'm gonna say they can't do it. I'm gonna say it can't happen. Like, it's fine.
You think they're gonna just buckle and because they're cutting rates? The problem.
Do you remember
QT?
inflation.
Listen, that just puts in more inflation.
When you and I were a kid, you're younger than me.
Just a bit.
When you and I were a kid, a can of Coke was 10 cents.
Yes.
Okay, call it a loonie. Why do you think in the first half of our lives, inflation was consistently 5 to 10%? Money supply growth due to World War II. And what the central banks would do is convince you that it really isn't there.
Right.
So they didn't want it embedded in the system. But we cannot go to a 0 handle on inflation. 2 becomes what they want us to think.
Mm-hmm.
Every financial plan that when I was a young broker, every financial plan that we did had inflation expectation of 5.
Interesting.
We had just come off 30 years of 30 years of 5. 2% over under, I'm over.
Mm-hmm.
Way over. They just can't. It has to inflate. You have to inflate. We have debt.
Mm-hmm.
The same amount of debt was incurred in the pandemic as a world war. And really, you're going to roll all 9 trillion of US treasuries? You're going to put those all back on the market? You tell me from a supply and demand, not only is Biden running deficits
Yes,
or Trudeau or any, I'm not picking on any political party. This is a Western world thing.
understood.
All the supply of bonds, you know, I'll tell you a little story. And that's when I was working one summer at the bond trading desk. And, you know, I'm the young kid. And one of the guys says, "Oh, Trudeau, Trudeau." And this, we're talking about Pierre. And I said,
Yes.
What? And he goes, you know, deficits means supply of bonds. Too much supply means lower prices. You run deficits, interest rates go up.
Yes.
We've forgotten that. We have forgotten that.
And now with the modern monetary theory that they've been playing with, you're actually now seeing, you know, the central banks buying those bonds through QT,
Listen, it was,
QE and so on. And so now that's all stopped.
it's all stopped. So now you've got no more. I mean, just think about it. $1 trillion of US treasuries were issued and $1 trillion was bought back. So they literally did what Venezuela did.
Mm-hmm.
So, you know, I carry in my wallet. Did I leave it here? Yes, I carried. Now we're supposed to disclose every time we get a gift from a client. So a client came in and gave me $200,000 bill. Unfortunately, it was from Zimbabwe. So when I checked, the foreign exchange was well under 1 penny. Keep in mind, this was on par with the US dollar in the 80s. It was exchangeable 1 for 1. And I carry it just to remind myself that money can be created and printed. And hopefully we do a World War II kind of print. But it.
Are you a gold bug here?
Yes, I'm not a gold bug. Like I'm
Fine.
not one of those guys
Yes, who's constantly.
Yeah. I think you gotta own some gold, and I'm not gonna back up the truck, but you know, you can own Barrick, which
Correct.
is a top pick of my favorite research firm.
Yep.
And you can get a 5% dividend. So,
Exactly.
so I'm patient.
Yes.
Making GIC rates, and I think you're gonna see and that I was talking to your analysts, and I said, isn't that the worst run company in Canada? And the good news is that it's changed management. So
right.
The old management is irrelevant, but they have the assets.
Right.
Anyway, I'm not here to talk about Veritas research.
Yeah, but that's interesting. Again, I'm going to remind everyone at the bottom of the screen there, hover over the Q&A and definitely ask a question, and we'll get David to address it. And so a question came in. It's actually a really good one, David. What are the key drivers for new asset growth?
You know, we got into our business, and my first day on the job was actually annual conference, and Bill Good was the speaker, and he was the guy. And you know, they used to call him the cold call cowboy. And literally, we began to cold call, and anyone that would listen to your spiel, you get a live one. So we would cold call on government bonds and make it low key, and then you would just try to engage in a conversation.
Yes,
and that's what we got our clients. Today, I think social media plays the biggest role for us, and we've done a pretty good job. We've with our clients. And because we put our podcasts on YouTube,
yes,
people forward a joke, they forward a car video or something, they're forwarding their videos. And more often than not, I get a call from someone, I watched your YouTube.
Mm-hmm.
Can we talk about my stuff?
Mm-hmm.
So that's been very good. I mean, you have to do a good job for your clients, but we're running net new assets at LePoidevin Group just over 150 million for the last 12 months. So I'm looking forward to this number 1 ranking. That was number 2. So that hasn't hurt. That hasn't hurt. So a few people have looked us up.
Very good. We're going to just launch our poll here, so everybody can give us let us know how you did, and give us ideas for what we can do next. They just hit the poll button. Okay, another question that I think is quite interesting here is: are you saying that 2% inflation rate's unrealistic?
Yep. Yeah, it's going to be higher. It has to be. We're monetizing. We have to monetize this debt. You know, we're trying. Money supply grew 40%. It's running zero, and you can get this information, everyone. It's at the St. Louis Fed, so it's published. They used to publish weekly, now it's monthly. So, and we used to hang on this data on the bond trading desk. I mean, the money supply was too much money supply. So everybody, it was the thing. Now the thing is the job numbers. The thing is the CPI.
Yes.
But they're all going to the soup. So we went 40% up in money supply.
During the pandemic.
Yeah, people, there's a shortage of used cars, there's a shortage of this, a shortage of lumber, but something was going to go up. Money, you can't dilute money. If you had a small town with a X amount of dollars and you doubled the money supply,
the price
of
up.
milk would double. You're no further ahead.
Correct.
The total GDP of anything is the productive capacity. How much production do you produce?
Right.
You don't produce more by printing.
Yes.
But there's a short term, you can print and you feel good for a little while.
Yes.
But we are going to see look, there's a little bit of productivity growth and a little bit of population growth. They're about 2 and 2. So 40% money supply says everything's got to go up by 36%.
Yes.
Now we're not printing now, we're at zero. The economy's stalling.
Yeah.
Can they keep going with this QT? Let's remember, after 2009, they bailed on QT. What I can't remember exactly, but it was 2 or 3 years into it, it was over. No more issuing bonds, and you know, so we'll see what happens. Very, very interesting going forward. But
yeah, for sure.
I think if you're talking to a 55 or 60-year-old who life expectancy, husband and wife, still is in the 90s, life expectancy.
Yeah.
I think you're safer to own a good business.
Yes.
That's my view. If you said, David, we're going to Mars, we're going to man the space mission to Mars, but you can't trade your account.
Yes.
You'll be back in 20 years. If you put me into a
quality
3% bond, I couldn't sleep at night. If you just bought me 20 high quality businesses,
yep,
I'll see what it's worth when I get back.
Yeah.
So listen, there's commercials on the financial networks about, you know, my investments are not volatile. These are just private investments that have as much or more risk than anything. But
they don't have any change in value, because I value them when I want to value them.
I value them once a month.
That's
from how we want to value. There's a big push to this, and I think this is a very dangerous asset class. Yeah. These alternative investments.
Well, you got to be careful what kind of alternative investments you're talking about. The liquid ones. You're talking some. I think there's some private equity that's going to get
private equity. Some mortgage funds have had it good for 30 years.
Yeah.
And we're already seeing 2 of them. Don't worry, but you can't cash out.
Yeah, that's right.
But not to worry.
Everything's going to be fine. You see, that's and I you know, for investors that might be listening, what the public markets offer you is liquidity. And you know, as we've heard so many times from the Godfather, liquidity is like oxygen. You don't know how much you need it until it's not there. And so, you know, you might get stressed that yes, your stock is down or your investment's down 5% or 10%, or maybe 1% in this particular day. But the point is, that's only because some small fraction of the company traded hands, not the whole business. And that's the key to thinking about long term in this business. Over the long term is just the best business.
We get regularly a call, I'm down. Mm-hmm. Okay. Now what they mean is you bought Bell Canada Preferred at 15. In February it traded at 20 and now it's at 18.
Yep.
I'm down. This is a very dangerous trait as an investor, because these markets are this volatility is here to stay.
Yeah.
And it's, you know, long dated assets are going to be volatile. Mm-hmm. So unfortunately there's a correlation now.
Yes.
And it used to be that bonds would go up. When I was young, bonds led the decline of stocks.
Yes.
Then under disinflation, bonds went up when stocks went down. One of the things that I had the problem with is I was convinced that we're going back to the old way, that a bond was not a good hedge. So now everything's correlated. So you could say, well, one way to circumvent risk is to have 100 different securities.
Yes.
Unfortunately, you know, on a day, risk off day,
Everything's down.
everything's down. And this is just something that you, a good investor has to deal with, because the cash, bonds are not going to get to where you need to be. I mean, think about it. One of our clients placed a very large multi-million-dollar order with RBC 1 year at 5.2. Like, wow, right? I mean, that's one of the drains of the market, right? That could have gone into equities.
Yes.
At 0, but 5.2. Okay, so you're paying in Ontario a 53% tax rate.
Yes.
What are you left with? Is that going, and you're not using that money. You are hoping that inflation comes down to 2.5
to offset,
but you're not enjoying the money.
Yes.
If you own your businesses, we're talking about, you spend the dividends and your business should grow. Yeah. That's how you retire. But this volatility, you know, Peter Lynch ran that Fidelity Magellan Fund.
Yes.
With this, it was something like 29% for 13 years that he ran it. They did an analysis. He talks about this. Fidelity was do-it-yourself. It was one of the first online, well, it wasn't online, do-it-yourself.
Yes.
There was no internet. The average investor made 4. Because they timed the market. That was terrible news. Let's sell. Yeah. And then when things got a little, you know, calmer, they would buy back.
Yeah.
The average investor got 4 in a fund that did 29.
Amazing.
So
anyway, last question from the group here. With debt levels so high, how can the government afford to pay the interests of the Fed rates that are so high?
Ooh. Well, now you're talking about, you know, when you know, the government of Canada, this is a little known fact, in 1982, went to issue their regular issuance of bonds.
Okay.
And this particular one was 17 3/4 of 02. There were no takers.
Right.
So when my friends tell me they will never let rates, people told me a year ago, they will never let rates get above 3. Well, here we are. And what happened was the bond market, remember James Carville? Yeah. When I come back in my next life, I'm going to be the bond market, because the bond market will keep you in check. In an emergency, the government of Canada ran out of money. So in 1982, they issued savings bonds that the people could buy. It was my first investment, about $100 savings bond, 19.5%. And let's remember, if you and I want a mortgage, we're going to go to RBC, we're going to go to CIBC, we're going to get the lowest rate we can.
Sure.
The government's no different. They're going to get the lowest rate they can.
Yes.
So when they say they won't let, don't you think Pierre Trudeau would like to have borrowed at 2%?
100%.
The market said, you know what? You're 17 3/4, not high enough. We are not lending you money.
And in those years, actually early 20s or early 80s, the Fed funds rate went to 20%.
Yeah.
Last couple things here. We're going to wrap up. Favorite book?
I'm going to give you 2 books, which I think are terribly timely right now.
Please.
Number 1, a book by Mackey written in 1852. And John Templeton used to talk about this all the time. It's called Popular Delusions and the Madness of Crowds.
Got it. Fantastic.
And I mentioned this book to my clients in one of my podcasts with crypto at 60,000 at Bitcoin.
Yeah. And
it wasn't just one, it was a few of my young guys said, you know, as an old guy like me, you should just, your podcasts are great, but don't talk about crypto. You don't know what you're talking about.
What do you know?
So I talked about it, and I think
poison.
I think you've got to read the book, and then, you know, it just helps you.
Yes.
Whether it was the marijuana, like, Charlie Munger said, how do you know you're going to beat the S&P 500? Because we don't do anything stupid. It's, the marijuana cycle, whatever it is, even in golds and oils, you can, when it's just frothy and everyone's making money, you can spot bubbles. So number one, Popular Delusions and the Madness of Crowds. And I think it's worth a reread for everyone, because everybody, it's a kind of a cliche, but Benjamin Graham's book, The Intelligent Investor.
Sure.
And, Warren Buffett talks about these discounted cash flows and everything. But there's a whole chapter in there on discounted fixed income. And if you look at these prefs, which were reset at, were terrible deals, which, by the way, we did short when they were at par.
Nice.
But now trading at $14 on a $25 preferred, to me, there was a whole chapter on that. And we're not talking about high risk. We're talking about as low risk, the toll master on a toll bridge. Just collecting the tolls on these kind of businesses. And if you're buying an Enbridge preferred, you rank ahead of the common stock. The common stock has a market value of 104 billion. That has to go before my preferreds go. So they're incredibly safe. But anyway, the Intelligent Investor, I think, is very appropriate for now. And let's remember as well, what's getting crushed is businesses that don't make money
or don't generate cash.
Yeah.
And that's because the cost of money is higher. It generates, you have a higher IRR to deal with.
And, the old, look, low PE stocks beat high PE stocks in the long run.
Yes.
You and I probably found it difficult in 1999, 2019, when FANG was the entire return of the market.
Yes.
And so us guys buying, pipelines and dividends. I mean, there was no, you couldn't, the markets were, Mr. Client, we made 7. My buddy's broker made 20.
Yes.
So anyway, I'm happy, look, I'm happy that, you have to do your homework.
Yeah.
Independent research.
Last comment on a favorite podcast.
I'm not a podcast guy.
Okay.
I would like to know from you, what I should be watching for podcasts, because I'm just an old fuddy-duddy. I like to read my stuff.
Is that right? I really like Peter Ziegler. He's a geopolitical guy and very interesting. He puts something out every day, a certain podcast. And it's like 5 to 8 minutes long, and it's just fantastic. I've tried to get them on this, and the other one is the Monk Debates. They put out a short piece every Friday, and called the Friday Focus, and it's very interesting. Again, they got Janice Stein on it with Rudyard Griffith, and it's a really interesting discussion. So there's a couple. You asked me on the spot. I didn't know that was gonna happen. All right. Thanks, everyone, and congratulations again, David. Keep up.
Thank you. Hopefully be back here next year for number 1, but
it's going
to follow up the gold medal.
It's
silver to gold, but anyway, listen, I've got lots of good competition out there.
There's definitely, it's a heck of an industry. Thanks, everyone, and stay strong.